Did you know that VA loans are assumable by buyers even if they're not veterans? So if you're a seller and you're sitting on a VA loan with a super low interest rate, this could help you sell your house faster. I'm Jennifer. I'm a loan officer for the last 27 years. My channel is all about real facts, no BS, everything mortgage, so that you can make the best decision on your next home loan. So the definition of an assumable loan is a loan in existence that's able to be taken over or transferred to a new buyer. Now, on a VA loan, which are loans specifically for our veterans, it is not mandatory that the new buyer that's assuming the loan is a veteran. Now, there's some benefits if they are, and then there's some things to watch out for if they're a civilian. So it's really important that you pay attention and watch this video further. So why would anyone want to assume a loan? The number one reason is interest rates. Interest rates are at an all-time high at the time that we're making this video, and so assumable loans are kind of coming back into style. So in a market where the current interest rates are higher than interest rates from several years ago, you're going to have a lot of people that have government loans, again, VA, FHA, or USDA, that are assumable. Those are the only types of loans that are assumable. Now, there's some things that you need to watch out for specifically on VA loans, and that's what we're talking about here. We're talking about VA loans. Are they assumable, and what you need to know? So it's critical for you to know that if the new buyer that's assuming the loan is not a veteran, that those VA benefits might not be able to go with the seller to their new property. So the seller might be not using the benefits, so it might not matter. They might be retiring or moving somewhere where they're not going to be needing a loan. So it's important for you to know and check that out. So you want to make sure and talk to the seller's lender as soon as possible and make sure you know if those benefits are going to be transferable or not. The other critical thing to know is that the seller needs to obtain a release of liability from the lender when it's all said and done. That way, if the new buyer doesn't pay the loan on time, it doesn't affect the credit or responsibility for that seller that's now vacated the property. Another thing to note is that there is a difference between sometimes the loan amount and the purchase price. That needs to be paid. So for example, if the loan amount for the seller is $200,000 and the new purchase price is $300,000, that $100,000 will need to be paid at closing. Now, the buyer might be able to get a loan to bridge the gap. They might be able to get a second lien loan, or they might have to pay cash for that difference. So that's one reason why an assumable loan might not be the best option. So thank you for sticking around. In the notes, I've got more information and links for you about purchasing your next home, closing costs, and what is a VA loan. I look forward to educating you soon.